Welcome, welcome, welcome. This is Canada's Startup, and I'm with Bill Wilson. And today we're talking about picking dividend stocks. Good day, Bill. How are you?
Doing well, thanks, Dave. How are you?
I'm doing really well. It's been actually a crazy day today. The markets were just on fire with Bitcoin going past 50,000 for the first time. It was on fire with stocks going up 30, 40, 50%. At the end of the day, there was a stock that we have went down 68%. And so it was a whippy day and a fun day because I guess at the end of the day, if you're doing some in and out, you're doing some trading, it can be very exciting this way. If you're doing some investing, there was some good bargains. And today we're actually talking about something that's very dear to my heart, dividend investing.
Cool.
When you think of dividends, Bill, what comes to mind for you?
Well, dividends, like I understand, that companies pay out, I guess, a reward or to their shareholders. So I was doing research on that because I'm interested in this. And there's this one stock, and I think we talked about it. F like Frank, IE like Edward.to. So I was starting to do the research on Yahoo Finance and then just sort of drew a blank because I don't really know what would be like 5 things I should look for to see if that's really something I should pursue.
Well, that's a great question. I'm wondering whether to answer it right away or should I start off with what to look for? Let's go with what to look for.
Okay, cool.
So we'll remember FIE.to because if there was one investment that I am quite excited about that was taught to me by 20-year-old Justin, my son, he's the one who pointed it out to me about a year ago. And it's something that I have invested in the last 3 months, and I'm quite happy with it. And so for any of our listeners or followers, we'll get you to stay around to the end and I'll do a little debrief on FIE.to. Yeah, let's just go through some of the things to look for in picking a dividend stock. Number one is you want healthy earnings. You want to know that the company can actually pay their dividend. This past year, we had a number of the dividend aristocrats. These are companies that had been paying their dividends for over 50 years, actually stopped paying their dividends. This is Royal Dutch Shell, this is BP, and the big one that a lot of people were wondering whether they were going to stop it or not was Exxon. Exxon ended up paying their dividend. They've committed to pay their dividend. Those companies, though, in the past year, 2 years, they have not been earning any profits. And so if you're not earning profits, you've actually got to go and borrow the money to pay your dividends. That's a big red flag. So you would like a company that has healthy earnings. And so I'm asking you to start thinking. In Canada, can you think of some big companies that have healthy earnings?
Well, 2 that come to mind, and they're ones I'm thinking about, are one Enbridge and BCE.
So if you think of healthy earnings, you think of Canada, you're absolutely right. BC, Bell Canada. You're talking profitability, consistent. Enbridge, a pipeline, fairly stable, yet they do have some issues with the Americans over some treaties. So there is some risk there. The banks, most of the Canadian banks make good money. We'll do a little dive deeper into the numbers to look for, yet you are looking for earnings per share. You're looking for profitability so that the companies can pay the dividend. Number 2 is you want companies that have manageable debt levels. And so when you're doing your review, you're looking at their assets versus their liabilities. Do they have a huge amount of debt? And again, that was the issue with the big oil companies. The big oil companies have huge amount of debt. So they're not going to default on their debt. They're going to pay their debt before they pay the dividends. So if you got a company that doesn't have as much debt and is paying a good dividend, that's something that, again, you're looking for in your checklist is, are the debt levels manageable? The other one that was very exciting for dividend hunters were the midstream providers of oil and natural gas in the States because they had high debt, but they were paying 10, 15, 20%. Now, what happened, though, is most of them were forced to cut their dividend by half. Yet, if it's 20% and they cut it to half, you're still getting 10%. That's not too bad, right?
Still 10%. That's pretty awesome.
Yeah. So that was the hunting that I was doing about 9 months ago when the price of oil and gas went diving, and many companies in the States went bankrupt because they just couldn't make any money, and they had huge debt. So many were forced to fold up. The number 3 is, are they in a favorable industry? How is the industry outlook? So you look at telcos right now, Bell, TELUS, the industry is looking good. They're moving into 5G. It's looking pretty good. You're looking at pipelines. The pipeline's pretty stable. Energy, Canada, again, pretty stable. Not going to be soaring, yet will likely be able to continue to be profitable. The finance industry, the banking industry, again, the Canadian banks are pretty solid, pretty reliable. You also could look at the insurance sector here. You could look at, those are the main ones to look at for in Canada. I've seen some analysts being recommending some Canadian companies that have like 1.5% and 2% dividends. I shake my head because these are the top picks of some Canadian analysts. And I'd like to really know where they're getting their analysis from, because when I looked at their numbers, why would you invest in a Canadian dividend at 1.8% when you can invest in some of them that we're going to be sharing today? I did my own analysis of it, and I couldn't find the answer to that. Number 4 is, does a management have a positive attitude towards paying their dividend? Are they considering themselves to be a dividend aristocrat? Do they like, again, having a relationship with a stable investment shareholder base? And again, many of the dividend aristocrats in Canada, they really stand by the fact that they've been consistently paying dividends. They know that retirees depend on these dividends. These are things that the company, the management is really committed. As long as they can continue to be profitable and grow, that dividend is going to be secure. Okay, so those are 4 of the key points that I would be saying. I'm definitely welcoming any of our listeners today if they've got another tip. I've also followed a little bit of Peter Lynch and Warren Buffett here and looked for some of their tips. Yet I distilled down those 4 for you today.
No, that's very cool. It gives me a start.
Now, let's go and do a little case study, because it's great to tell you the theory, because, again, that's nice as a framework for you. Yet let's go and do a couple of reviews. So the first one we're going to take a look at is one that I've shared with you a few times, yet it is relevant for pretty much any of the Canadian banks. And I happen to have enjoyed an investment relationship with this company for over 30 years. And it's, if we were to take a look at the summary, which I'll click on here, and let's just get it on the screen for you. So we'll do that, and we'll go here, and we'll go here. So can you see the screen?
Yes.
So this is Yahoo Finance. This is ry.to. And you like to take a look at the chart, because, again, you're looking for trends. You're looking for one-year trends. This looks pretty consistent, right? The stock continues to grow. It's gone from a low last March, which would have been a great time to buy it at 78. And right now we're sitting at 106. And we're pretty flat right now. That is consistent of many of the Canadian banks. Now, if we scroll up and we see the dividend yield is 4.07. When you think of a 4.07 dividend, what comes to mind?
So is that 4%? Is that per month or per year?
This will be per year.
Per year?
Yes. Yeah. So they pay their dividend, and we'll just see if we can get that information here. Is the dividends. Okay, so the dividend date is February 24th. The ex-dividend date is January 25th. So people who hold the shares on January 25th will be paid their dividend on February 24th. And I could check to see if it's paid. It's paid shares outstanding most quarterly. So let's just take a peek here. So the Royal Bank is paying. That's one thing to check out, is to see if they're paying quarterly. I believe they're paying quarterly.
Okay.
Okay. So what they'll do is they will pay about $1.08 per share quarterly. Okay.
Okay.
And in their next filing, they might announce that they'll increase their dividend, which is what the Royal Bank tends to do.
Okay.
Okay. So they tend to increase their dividends. So do you have any other questions about that little analysis? So they've got earnings per share of 7.8. They got a PE ratio, price earnings of 13, which is considered pretty conservative, a market cap of 151 billion. And their dividend is 4.32 per year, which works out to be 4.07%.
Okay.
Which the way you calculate that is 432 divided by the price of the shares right now.
Oh, okay.
Okay. And the thing is, while it's considered to be a conservative stock, which I do believe it is, yet it does have, again, a 52-week range of 72 to 109. So if you were to pick some up when it's dropped at 72 and you actually have the courage, because you think it is going to survive, you might buy some at a low rate. And you might, when it pops up to 109, you might sell a little bit. And that's what, again, is having a core position that allows you to trade around a position, which we've talked about once or twice.
Right, right. So where on there, where would you see the debt part? Would you see that in this chart?
If we went to look at debt, we would go and take a look at the financials, which again, you can take a look at the page here.
Oh, there we go. Okay.
And so you can look at the income statement, the balance sheet, or the cash flow statement. So this is the income statement, which again shows they have about 11 billion in revenue, income for just net income. Now, if you were to go into their balance sheet, again, balance sheets for banks are pretty sophisticated, yet the total assets is, I guess this would be 1.6 billion, 1.5 billion. So they have quite a bit of room. But you do look at the cash flow to get an idea of their debt repayment, common stock issued, and dividends paid.
Okay.
So that's the amount they have to pay. Out of 11 billion they're making in net income, they're paying about 6.3 billion in dividends. So about 50% are being paid in dividends. So it's a big obligation and it's a big commitment.
Yeah.
Okay.
Very cool.
So let's go to another company, which would be one that you've also been interested in. And so if we were to go to Bell Canada and we were to scroll up, I'm not sure if you can actually see that very well. Can you see that?
Yeah.
Okay, great.
Yeah, that's good.
So Bell Canada, again, if you look at the year chart, wow, that's really flat, huh?
Pretty, yeah. Considering everything that's gone on, it's very flat.
Yeah, and so yet annually it's gone from 46 to 65. So it's giving you some good opportunities. Yet you can see it's got a $3.50 dividend, which works out to be to 6.3%, which you take 3.5 and you divide by 55.
Right.
And ex-dividend date is March 12th. So if you were to get some of these shares, you would be able to get the next dividend payment.
Very cool.
And so let's just go into the statistics here. And if we talk about the statistics, so the dividend is 3.5, 6.3 is the dividend yield. And it's increased in the last year from 3.33 to 3.5. So they had a dividend increase. The average dividend for the last 5 years is 5.1%. Now, this is a little concerning. The payout ratio is 132%. So, in fact, they're paying out more than what they can actually do for the long, long term. So that would be a bit of a flag.
Okay.
Now, I would be looking at their revenues, their gross profits. And so that is something to be aware of for Bell Canada.
Okay.
So their total debt is 26 billion. Total cash is 224 million. So they obviously have some debt issues, which means that they do have to watch their cash flow very carefully.
Right on. What's that part? Dividends and splits. What's that last part where they talk about splits?
Periodically, a company will split. We saw that last year when Apple split, Tesla split. Quite a few people are actually calling for the Royal Bank to split. They haven't split since, I believe, 2006. And so right now at $100 per share, for you to make your first investment at $100 per share, you might be a little bit hesitant. If it was $40 a share, you might actually feel a little bit more confident.
Right.
And so the Royal Bank, back to about 15 years ago, they split quite regularly, and then they would split from $100 down to 50, and then it would go back to 100, and it would go down to 50, and it would allow their investors to double up on the shares. And that was something that I believe that their chairman right now has been asked about splitting that for some time, and calling for right now. Shopify is a company right now that a lot of people are calling for them to split their shares. Amazon, people would like to see them split their shares. So it would mean if you had 10 shares and they split, they would take your shares, say, from $100 down to $50, but issue you the equivalent amount of shares.
Right.
All right. So let's go to the other one that you've been looking at, which is Enbridge, which is one of the darlings for investors because, as you can see here, let's just call this up for you. And Enbridge has a dividend of 2.63, an annual yield of 7.61. It has gone up in the last year.
Nice.
Now, payout ratio is 330%. So again, that's a bit of a red flag. Okay. Is their dividend safe? Some people would say absolutely, yet there is definitely some something to be aware of, is that they have to watch their cash flow to be able to be sure that they can pay their dividend.
So potentially you want to see that number less than 100, ideal less than 100%.
Correct. Correct. Yeah. And they have a total debt over equity of 106. So this company is definitely a company to watch their cash flow, and it's one of the reasons why it does pay such a strong dividend, is to keep people interested in this company as a dividend-paying stock.
Is that a Canadian page you're looking at there? This is the number, like
this is
$34. The US that's 34 Canadian?
That's the US one. So let's go to the Canadian. Enbridge.to. There is 44.11. Earnings per share 1.48. For dividend 3.34, 7.59%. And ex-dividend date is February 11th. So we've just passed that. So they will be paying their dividend very shortly. And I guess I'll be getting a check from them or new shares. I have a dividend reinvestment plan with them. So on March 1st, I'll be getting more shares.
I was reading somewhere that program is not available anymore, like for new people. Is that true?
That is not true.
Okay.
It might be the fact that you might be using Wealthsimple, and Wealthsimple probably doesn't allow it. So here we are with the revenue of 39 billion, gross profits of 18 billion, EBITDA at 11.2, net income available to common 3 billion, and their debt, as you can see, is 68.44 billion. Debt to equity 106. So They have operating cash flow of 9.78 billion, and this definitely is a reason why it is so high of a dividend, is because there is some risk that there could be a suspension or of dividend if they did have a long financial challenge or difficulty.
Right on.
There's definitely some risk, yet it does pay you for that risk, and that's why it has a 7.6% dividend.
Nice.
Does that make sense?
Yes.
Okay. So they're paying you for it, but definitely this has got a red flag, yet they're paying you for that red flag.
Right.
Let's see what else we could share with you on that one. And then we got one more for you, which is Power Corp. You ever heard of Power Corp?
No.
It's an conglomerate, and it is one of the strongest companies in, I believe it is registered in Montreal. Yes, Montreal. And so in Yahoo Finance, they've got a lot of good information that you can go around and look around and see all of the information. This company has gone from 19 to 30. It has a dividend of 1.79, which is 5.82% right now, based on a $30 share, 30.75. And target is 33. So this one is considered quite often to be a darling of Canadian finance. Statistics.
So what's that target for that you just pointed at?
That is the consensus of the analysts' opinion of where this stock will be in a year.
Oh, I see.
So we've got a dividend 1.79, 5.82. It has gone up from 1.75. The payout is 83.75. So one could surmise that this is a little bit less risky than our friends BCE and Enbridge.
Right on.
Total cash, 112 billion. Total debt, 20 billion. So it has a fairly strong balance sheet.
Cool.
Is that useful?
Yeah, no, that at least gives me some stuff to look at. Okay. And I can understand, where to see a red flag. If somebody's talking, oh, this is great, but they haven't done the research, and I can go in and say, well, what about this?
Absolutely. And so this is the front screen of Yahoo Finance. I tend to look at the chart just to see what the trend is.
Okay.
This gives you a synopsis of the bid-ask right now, the range for the day, the 52-week range, which I'd love to always look at, because this gives you a parameter if you wanted to trade throughout the year. Because again, I'm not encouraging you to just buy these things and put them in the closet. I want you to develop a relationship with these companies. Pick companies you like.
Right.
And so even their one-year target is 33. Some people say, oh, that's not very exciting. Well, if you get 10% appreciation on the stock and a 5.8% appreciation or dividend, that's a 15% return. That is very good in my reality. Yet many of the young Robinhood investors want 15% a day.
Wow.
And so that's part of the euphoria that's happening with GameStop. They want 100% in a week.
Wow.
They want to make 1,000%. Yet, guess what? Our friends who have invested in Bitcoin in the last year have had over a 600% return.
Wow.
If you've invested in some of the stocks that we talked about, Riot and Mara, that has been 1,500% in the last year.
Wow.
Even in the last 9 months that we started talking about some of these stocks.
Yeah.
So that's something to be very cognizant of. Yet what we're talking about today is conservative. The idea behind dividends is that you're making money while you sleep.
Right.
Like there's a big promotion idea of what Robert Kiyosaki likes to always talk about, passive income. Now you take it to the extreme where if you totally ignore it and you don't put any energy into it, I don't believe necessarily in passive income. If you don't focus and you don't nurture the garden, then guess what? After 5 years, your garden's going to be a weed factory.
Right.
So with your dividends, I'm asking you to pick some ones that you like. We've looked at 4 today.
Mhm.
Start the relationship with it. Maybe the dividend reinvestment would be great because then you'll start to see the dividends come in. If you have enough to buy a share, the broker will buy the share automatically for you. So like, so if, say you have 5,000 in Royal Bank right now and it's 5%, 4% dividend, you'll get, let's say, $100 of dividends. If the share is at 106, they won't buy it. They'll give you the cash.
Okay.
If the share is at 95, they'll buy the dividend, they'll buy the share, and they'll give you the remainder.
Oh, okay.
And so that's how it works with a dividend reinvestment plan.
Okay.
And so with Enbridge coming up, I'll probably be getting about, it's $44. So I'll probably be getting about 15 shares.
Okay.
And probably like $22.
Right on. That's all
and
right.
So if that happens every quarter or every 6 months, that's nice because at the end of the year, it's invested 8%,
Right.
7.5% in new shares for me. That's a lot better than sitting with your bank account dividend or interest rates of probably 0.55 or something.
Right.
So let's look at the one that you asked about at the beginning.
Oh, okay. Yeah.
Which I believe you remind me is FIETO.
Yeah.
And this is actually one that I absolutely did my homework and I fell in love with it.
Cool. So when it's the .TO, that means it's on the Toronto Exchange?
Correct.
Okay. So if it's .NY, that's the New York Exchange?
I don't think it is a .NY. It's just if most of the codes for the American ones are just the ticker.
Oh, okay.
Okay. So are you able to see that? Yes?
Yes.
So we're looking at FIE.TO and we're looking at the 1 year. And so it's been relatively stable, yet we did have that drop at 4.828. So the yearly rate was 427 to 744.
Okay.
This is a ETF, an exchange traded fund. All right. And so in this exchange traded fund, it has a lot of financial institutions in their holdings.
Okay.
So what they have here is the financial institutions such as Royal Bank, Manulife, Sun Life. Now, if you wanted to do a homework, you could actually go and do research onto each of these shares to get an idea of what dividend they're paying.
Okay.
So this fund holds these ETFs plus these shares. Does that make sense?
Yeah. Yeah.
So this is a nice button. You could go into all of the ETFs and find out what they're holding. Okay. So this is 96% of financial institutions and 3.9% real estate. Now, what's fascinating about this one, it is the fact that it has a 7.08 payout.
Wow.
And when is it paid? I'm trying to show you when is it paid because it is paid monthly.
7% monthly or 7% divided by 12?
7% divided by 12, but payable monthly.
Right on.
Which is lovely. Like this is one that pays you a dividend every month.
Nice.
And so for me, that was quite a pleasant surprise. Now, has it had some volatility? Yes, it's had volatility over the last couple of years.
Right.
Yet the volatility has primarily been pretty good. All right. Over the last 10 years, 7%.
And this one, so when a dividend comes in on this one, they just send you a check?
Well, they've deposited into your account.
Okay.
So this is probably my favored way now to consider holding cash.
Instead of putting it in a savings account, put it into this.
Correct.
Right on.
Now there's risk, yet I think it's pretty manageable risk.
Yeah.
There's market risk, yet there's also a nice upside, a 7% upside.
Yeah, yeah.
And again, if you look at even the year-to-date daily return, the total return has been 5.5%. 5%. So it definitely gave an alternative to just leaving money in an account. And it was, again, something that my son pointed out to me, which I've found in the last year, listening to my son and finding ways that he's investing has really taught me a lot.
That's cool.
And I know
when he spoke, I was mesmerized.
So it's good for us to have the young ones in there to guide us a little bit and to give us the latest in technology, investments, and different types of products that they're seeing, because right now they're looking at everything through Twitter and their Reddit and all of these sources that, frankly, it's not in your or my first way of communicating.
Right.
Or second or third or fourth.
Yeah, exactly.
So that is a little bit about dividend stocks. Is there anything else that you might want to ask, or any part of that Yahoo Finance page that I might be able to share with you?
It doesn't tell, when you look at the dividend stock, will it tell you if they have the dividend reinvestment plan?
I will think about that for 1 second, because I definitely think I'm wondering where I see that, because I definitely see that quite often. And so I'm just going to consider, where would the dividend reinvestment eligibility come up? I think it's here. Let me grip the eligibility. No, that didn't work. So let's go to, I'm going to have to come back to you on that one.
Okay.
I was just taking a look at a couple different places, and it doesn't say whether it's DRIP eligible. Just scrolling down.
And if I just to confirm what you said before, Wealthsimple, you can't do the drip in there. You need to go into something like a TD account, like something from one of the banks.
That is my understanding. To be very aware that they're constantly changing and updating and making amendments. So as of today, my understanding is that Wealthsimple does not facilitate drips. So that is, it's one of the issues if you want to be a drip investor, that you've got to use an existing financial institution.
Right on. Otherwise, you got to manage all that yourself.
Well, I don't think you can do it. Well, not through Wealthsimple. They just don't facilitate that that transaction.
Right. Otherwise, with the drip, it reinvests on its own. You just sort of you would just, I guess from what you were saying, just you want to keep up to date with the stats and whatnot. Whereas if you did it through Wealthsimple, you'd have to collect the dividend, decide what you want to do with it, do the transaction yourself, and add all that extra time in.
I guess that's probably accurate. Is they're going to put it in they're just going to simply put it into your cash account.
Right.
Now, the beautiful thing about Wealthsimple is that you can do transactions without any transaction fees.
Right.
And so once you receive the dividend, you can simply go and just buy the shares. So that's a pretty good component of Wealthsimple.
Yeah.
I'm doing a lot more trading because of Wealthsimple, because you can do much smaller trades and you have no transaction fees.
Okay.
Now you got a bid offer, which is what they'll buy it from you and what they'll sell it to you. yet it doesn't come across as a $15 or $20 or $10 cost for every transaction.
Right. So yeah, there's a lot more activity because of solutions like Wealthsimple.
There is a lot more activity, yes. Wealthsimple, Robinhood, a number of the platforms that are even coming on and becoming new in the States are facilitating that. Yet today's news is that they might actually go back to start charging because of all of the kerfuffle with GameStop and AMC and the settling process, that there might actually be some reintroduction to some fees for some of these platforms.
Right.
So this is a very dynamic industry. It's a very dynamic process. And that's one of the reasons why some people say, just put your money into an ETF or mutual fund. I am inviting you to continue to work on your financial literacy. Ask questions. We can have definite sessions like this. Anyone who wants to ask some questions, you can add a comment, you can give us some feedback, you can ask for a topic. Bill and I are here with Canada Startup to not only elevate financial literacy, we're also working with entrepreneurs. Because if you're an entrepreneur and you're not familiar with the ways to raise money, what dividends are you really calling yourself an entrepreneur? Again, it's a big step maybe from a solopreneur to somebody who's thinking about building a business that can be sold or potentially listed. And that's one of the reasons why I think it's so important for any aspiring entrepreneur or entrepreneur to start really delving into financial literacy, because it's the way that you're going to be able to leverage value and monetize the value of your enterprise. And as an investor for you and I, Bill, it's there's definitely dividends are the way that you can create a nice portfolio. Right now, if you had a portfolio of about 100 grand at 5%, that's about $5,000 a year, which is over $400 a month. That can really allow you to have a little flexibility in what you do. And if you work on it for a decade or 2 decades, you build a $500,000 portfolio at 6%, that's 30 grand a year in dividend income. 30 grand a year in dividend income for some people, that's a nice addition to any other types of retirement funds that they might have.
Yeah. Oh, yeah.
And so for the next 10 years, if you work on it and you develop it, you can have an investment portfolio that can provide you with some nice revenue while you sleep.
Yeah, that'll be great. I like that idea.
And I really do believe in it, because I've been a dividend reinvestment since I was for over 35 years. And some of those shares I still own.
Right on.
And it's been a great way of building some type of financial literacy and also flexibility. And that's what we're here to share, is financial flexibility. If people are interested in understanding the levels of financial freedom, financial flexibility, financial security, financial viability, these are all numbers that can be put together. And maybe in a future session, we'll sit down and go through and come up with your financial freedom number, which is a fun little exercise that we can explore in a future show.
No, I think that'll be fun, because I sometimes question some of these things that you hear, on the commercials and some of the articles they put out there. Sometimes the numbers just don't make sense.
Absolutely. Again, the big number for finance is often that magic 8%. Oh, if you get 8%, everything will be great in your life. Well, how do I get 8%? And
Right.
So that's actually a little bit of what I'm doing here with you, is I'm sharing with you 4 different stocks right now. One's giving you an 8%, one's giving you a 4%, one's giving you a 7%, and one's giving you a 6%. Put that together. If you pick those 5 shares, and some's going to give you monthly, some's going to give you quarterly, some's going to give you 6 month. And so you can actually have a blended cash flow. And if you work on it and you and your team work on it, you can actually have a portfolio of dividend stocks that can provide some people with a nice supplement to what other types of revenues they have. So
that's cool.
I do love it, dividends. I love sharing about it. And I've also been a recipient of having dividends cut. One of them this past year, if you want a little advanced research, ET, Energy Transfer Partners. I did buy it when it was an 18% dividend, and
wow.
it got cut. So it's now a 9% dividend. The worry was they were going to totally cut it, but what they did is they reduced it by 50%, but then they did pay the 9%. So that was nice. And I did do the work on the midstream pipelines, and I picked up a couple at like 14 and 15%. What happened is you bought them that level, but then the price went up. So the dividend now is about 10%. But they've paid, and that's something that by doing some research, and that's what I'm encouraging people to do, is to do some research. If you got some questions, ask. This will be on our YouTube channel, Continual Shift. Make shift happen, because in life, shift does happen. And these markets, there's a lot of shifting happening. Any last questions before we bring the session to a close, Bill?
You know what? I think I'm good this week. That's a lot to take in, and no, it was very good. Thank you very much. I really enjoyed it. But yeah, that's it for me for this week.
All right. Well, thank you so very much, everyone. Thank you for joining us. If you did like it, please hit the subscribe on our YouTube, add a comment, add a like, and we'll see you next week for Canada Startup. Thanks very much, Bill.
Thanks, Dave. Thanks, everybody.